Hey everyone, Tom here. Today we're going to be talking about the latest stock market news ahead of some earnings season results this week, our technical analysis thoughts on the S&P 500, Nasdaq, and also a chart of the day which I think will help everybody to better understand conservative entries and why they might pay off for you over the long term. Stay tuned. Ahead of market open, not too much to note, but one thing I wanted to say was just crude oil and Brent, and they're down about 1.55% and 1.23%. The reason I mentioned things like crude oil or I mentioned Brent in general is they can be precursors to crashes as well as show us a little bit of sentiment in the market. And sentiment's very important when we're looking about real market sentiment versus maybe the FOMO effect that we're seeing on certain shares right now. Here we have the resistance on crude oil. And look how obvious it is on this chart. $41 resistance, incredibly clear. Every time it gets up here, it sells off. And that's a key level that we want to see broken in terms of seeing more bullish sentiment on crude and therefore the economy. Remember, crude is a direct kind of supply demand scenario. If we are seeing demand and we're not in crisis lockdowns, then we will see it go up because it is kind of undervalued over the long term. However, OPEC have done a good job of getting it back up here, but even countries like Australia, where I am, we're locked down in Melbourne right now, and I can tell you I've never spent less in my life than over this last 6-month period on crude in terms of buying fuel. I have absolutely not spent barely anything because we're just not allowed to do anything here in Australia. So while we're in lockdown, many other places are, and crude shows us a lot of sentiment. In fact, it precursored a lot of the crash coming into February. If you actually have a look at the key breaks on crude, you'll notice they happened slightly earlier than the S&P 500 break did. So always look at those cross pairs. In terms of earnings, PepsiCo is doing its earnings today, but tomorrow will be what you want to watch. JP Morgan, Delta, Wells Fargo, and Citi are all doing their reports, and these could be very interesting indeed to see what's really going on with some of the economy. Financials and of course the airlines have not done well during this crisis, and what we're about to see when we look at it in a second is that this really makes up some of the sentiment that's really underpinning these markets. In terms of the markets though, what's running them? Well, a lot of FOMO in very specific shares. And here is a great chart. This is a chart from wolfstreet.com, and it shows the Wilshire 5000, which is meant to be the top 5,000 stocks, but it's like 3,600 or something. You can correct me in the comments down below on that one, guys. But Apple, Microsoft, Amazon, Google, and Facebook are the top 5. If we take them out of the scenario and just look at every other share in that index, look at our returns over time. So if we invested our money in 2018, you'd think, yes, we would be up money. Well, at some point you were. But if we look at where we are now in the crisis, look at this. You would actually get no dollars back on your money. You would have been better in cash. Ray Dalio calls cash trash, and I kind of agree with him because of the stimulus that's gone into the economies now over the long term. But cash would have actually beaten this particular index. And this will bring up a key thing that I'm going to talk about on this channel. If you want to learn more about why indices might be a little bit dangerous over the next decade, make sure to subscribe, hit that bell, and of course, smash the like button to help out the channel. So very clear these giant 5 are making up everything that's going on right now in terms of sentiment, and we're seeing very specific stocks being targeted as well. So we've gone from 10% of the Wilshire 5000 in January 2017 to over 20% as of July 2020. This isn't the S&P 500 we're talking about. We're talking about all the stocks. That is completely wild to me to think that it's this high. And this has not boded well in the past in terms of general market conditions. We really don't want 5 companies being everything. We want a nice diverse kind of stock market so that we can trade other sectors, see sectors rotate in and out. And on top of that, you also see a better, more broader based economy. So here is kind of a chart of why the market is doing well. Look at all the things that are still not doing well. Energy is still down as of now. We've got airlines down huge. We've got hotels and resorts down big. Restaurants are down. Retailing is up. And of course, information technology is up. Consumer discretionary is up. Communication services up. But overall, financials, all these things, there's a huge amount of down sectors because of the crisis. So while a lot of people are probably thinking, well, the markets aren't pricing in correctly, what's happened is the markets have priced quite a lot of shares relatively correctly for the crisis, But then there's been this massive overreaction, I think, in the tech stocks. We are seeing it specifically now with the retail herd hitting up all of these electric car vehicle stocks. Tesla is wild. Even a bullish person on Tesla must be thinking, well, number one, they're thinking, yes, I've made a ton of money and this is awesome. But they could also be left thinking, why didn't I take profit at a certain zone? Tesla is getting wild. I'm telling you, I've seen this before quite a few times in the market, and it doesn't usually bode well over the longer term. So make sure you've got a plan in terms of stop losses, take profits, and an idea about what you want to achieve out of your investments. Speaking of sentiment in the market, fear and greed index here is now showing greed. In particular, I always circle this one here, which is the put and call options, CBOE 5-day average. It is dropping, as in we are seeing an increase in calls. Many people are trading calls. If you look at Google search and look up buy calls in terms of just people buying calls and interest in that, it is the highest it's ever been since the tech bust. So since the heights of the tech bust, we've never seen more retail people buying calls. And buying calls is great at the right time and understanding them. And I love options. Don't get me wrong. I'll talk about options on this channel all day long if I want to. But that being said, it's all about the timing for those things. Timing for options is so important, and they can be dangerous when not used correctly. So put call options starting to get down, and that usually bodes badly in terms of sentiment, because we're going to see super bullish sentiment, but that means what does Wall Street want to do? Take money off everybody else. And I see that just around the corner in terms of where the Nasdaq is, almost hitting that 11,000. So let's get into the technical analysis today for a few pairs. Well, first up, dollar index. Dollar index, here's the lines we drew last week together on this channel. We talked about the resistance up here at the 97.60. It failed to get through there. We talked about this trend line down here and how the market comes back up and tests trend lines. And I'll just quickly zoom that in for everybody to show what happens. So this is it always shows you've generally got a decent trend line when this happens. So when the market breaks through and closes below and gives us confirmation, and then it comes back up and it tests that trend line, that usually means you've drawn a correct trend line. Now, I'm not a huge fan of trend lines. I'm a fan of horizontal support resistances and things that make sense and things that you can go back over in a month and say, hey, hey, Sally, look at this, look at my technical analysis. And she says, absolutely, that is the correct thing. I see what you're seeing. If she says, what the hell are you talking about? Well, that's not good. And that means you've probably done poor technical analysis. It must make sense and it must be clear, because you're putting your hard-earned money at risk every time you place a trade. And that's what I want to talk about. It's about patience in the market. And I've definitely had some hard learnt risks over the years in terms of not having the patience. So we saw that rejection. It's come down to the support level here at the 96.40. It's bounced off a few times. For this to really be a fully fledged kind of close below, we would want it underneath this zone, the 96, and then it would go and test this previous 95 level. That's what I would expect. Right now, we're just seeing a little bit of trading within the zone, but in general, they've printed a lot of course, American dollars. And if they've printed a lot of American dollars, it shows in the weakness. But I look at the dollar index from this perspective. Risk on, risk off right now. If risk is on, as in everyone's bullish and we're getting into the stock market, then dollar index is generally dropping. If risk is off, then dollar index is generally strengthening as people move into the hedges and into other assets. So very important with the dollar index. So I mentioned that Nasdaq before, and the Nasdaq, of course, continues to flow up through this 20 moving average, this 20 EMA, but we are about to reach 11,000 on the index. We are sitting 10,900 pre-market. So 10,900 pre-market. I said a few weeks ago, once it broke this high, that I thought it was going to go to 11,000 purely just to get there. Now, usually in the market, what things like to do is they like to stop just before and then sell off. That's actually what happens. It's like that trap kind of concept. Will that happen again? We don't know. We really don't want to be even calling that kind of thing, because you want to see the price action show you the way with a series of lows and highs that change the trend. But in this case, we are about to reach 11,000. In my experience, generally we're going to do one of two things, and that is we either stop before, or if we get to 11,000, usually it bulls through it a bit, creates that kind of sentiment that's like, oh my God, I have to be in, I have to be in. And then that comes down, because that's usually the full trap before they reload off zones. Now, because of the price action that's happened on this, what's going to happen now is if it does sell off, there's actually going to be a lot of buying pressure around this 10,200. And you might think, well, that's stupid. Why is it up there? Well, because it's moved so far up. Now the sentiment is this is the dip and we're going to buy that dip. The biggest dip is, of course, back down here at the 8,800, 9,000. That's where there's a huge amount of resistance that will act as support. But this will now be the point. 10,200, 10,000 will act as buying pressure. At that point, we would be seeing, though, that the market might even be getting through that 20 moving average. So important levels to watch on the Nasdaq over the next couple of weeks. Similar to our discussions today about how the real market is a little bit different to, I guess, the tech market, we have the Russell 2000 here. The Russell 2000 has been weaker than the other indices. This is the 2000 stocks in terms of the smaller ones. We are not seeing the kind of strength that we've seen in the S&P 500, Nasdaq, or even the Dow. It is weaker overall, and it is struggling to make new highs. I've said for a while, if you're looking for shorts, you're better off actually not shorting the S&P 500, but you're better off picking the poison. And the poison would be the smaller companies because they're the ones that aren't able to get the Fed's money as easily, so they can't get the support. So what happens? Their earnings suffer. So the smaller companies are definitely suffering at the moment. We are seeing some weakness here, and it's important to note for sure. Onto the S&P 500, we are sitting at 3,203 ahead of the open. We are above the 3150 buy. We covered all of this yesterday in our week ahead analysis, which we do every single week on this channel. And realistically, if we zoom it in and have a look at the kind of price action on the futures, you can see how it interacted with this zone, what this break really means in terms of if this happens in the real market, and we would expect it to gravitate to the previous resistance. Now, we mentioned yesterday that on the weekly, if we saw a close above the 3,200 on the weekly, that meant that it would go back to previous highs, as in the high at the point before the crisis, 3,400. However, we aren't there yet. So we're just above. We expect it to probably gravitate into the previous resistance and to find selling pressure here. And the reason it will is because there will be sellers here. There are going to be people taking profit that have traded it within the range. And effectively, we are just in a big range. We're in a big channeling range between 3,000 and 32, kind of 30 up here, with the key zones for the weekly being the 3,200 and the 3,000 level. So really, we're in a bit of a range. We do not know what's necessarily going to happen next. This is one of those situations where I think that if you're looking at trades, there's no real strong trade here. I've mentioned quite a few times, the better trade here is to wait for it to break, wait for it to return, wait for it to do a smaller time frame change of trend, and then take it long. If you're looking more at the short side, it's better to wait for it to come to the peak, find the weakness, come back up, and then break through this zone here, this 3150 on the real market, and then take it short. Sometimes there isn't a good trade within a zone, and that's what patience is and what's so important about being good at technical analysis. It's about picking your fights with the market, because every time you go in, you are basically in a tug of war between the bulls and the bears, and you want to be on the side where the big money is pushing it in the right direction. So that brings me on to something I discussed in our private Discord Telegram group with a bunch of members. And if you're not sure, you can check out our courses at fxevolution.com. I don't really talk about it much on this channel, but you're welcome to come and join the private Discord group if you're excited about that kind of concept. So we talked about this last week. We talked about the pound US dollar. So we don't only trade, of course, stocks. We're into really anything that moves as long as it's solid and it's a quality kind of investment. So here's the pound US dollar, and this was a left shoulder, head, and of course, right shoulder from the perspective of a inverse head and shoulders. There's a couple of things to break down here. One, so many moving averages at the right shoulder. So if you were buying, let's say off the break here, off when it pulled back and tested the neckline zone, you have so much dynamic support behind you. It's very difficult for the sellers to push underneath this zone because of all the buying pressure. We've got moving average people with us. We've got everybody that's going to be with us, possibly with us at around this zone. It's going to be incredibly strong. So that is a very strong point. But what we're seeing now is also very interesting. So remember, with a head and shoulders, what are we expecting? Well, we expect it to go the range of this distance. If we make that range, where is that predicting to? Well, it's predicting to the previous peak. Why is that important? because it's showing you a self-fulfilling prophecy. Did we expect it to find resistance here? Absolutely. Absolutely we did, because that was previous resistance. It's the big problem for it to need to get past. We've seen multiple touches to the 20, which have been respected during this move. Look at this, 20 touch, 20 touch, 20 touch, 20 touch, 20 touch, and again on the Monday, the 20 touch. We're now waiting for it to break above this zone. And then what do? If we're not in it, we wait for change of trends. And of course, that's the potential for what we're doing with the pound US dollar. So one thing I want to bring into the story of today is that wait for confirmation is key. But then when you're being patient and waiting for that role reversal or waiting for the market to come back down, you've always got to think about, if you miss the first opportunity because you've recognized a 4-hour or a daily head and shoulders or inverse head and shoulders, why not then break down that chart to a smaller time frame and try to trade the direction that the bigger pattern is showing you? Remember, the bigger pattern shows you a well-defined money flow change in direction. So that's the key that I want everybody to get out of today's video, and I hope you found that helpful. Remember to subscribe, like the video if you enjoyed it, and we'll see you in tomorrow's video. Good luck everybody today, and good luck everyone this week and over the next coming weeks. I think we're in for some fireworks.